Well, we are talking finance now on the continuation of our Landlord 2020 Vision campaign running throughout January here on Property Tribes, and I'm very pleased to be joined by Graham, who is from FAR Financial, which is part of the Less Tax for Landlords group, who are sponsoring this entire month of content, powering the education streams. And Graham, I think, when it comes to finance, all the time on Property Tribes we see newbies coming and they're talking about strategies and tactics, and it turns out they haven't spoken to a mortgage broker or an advisor. And I guess what I'm trying to say is that finance is the absolute lifeblood of a property business, and it has to come first.
You're absolutely right, and I suppose what most people do is they become so focused on mortgages or rates, actually they forget they're running a business and realise that this is just a mechanism to help run their business. Yes, rates are obviously important because it's the cost, but it's all about what you're trying to do. There's no point trying to get the lowest rate and tying up so much capital in one property that actually the yield of that property goes down. So it's actually, how can I get my capital to stretch but still give me the security and return that I need for my business to grow and reach my goals.
No, absolutely, and there's no point in sort of basing your calculations on the lowest rate if you as an individual don't have the circumstances that allow you to access that rate. And I think, a conversation with a broker or a financial advisor is the most important thing that a newbie can actually do, because they might be thinking, for instance, about starting out in HMOs, which we would not advise here at Property Tribes, but they might have been on some property trainer guru course or something and think that's the holy grail for them. And then it turns out they won't be able to access that type of finance. And, I'm sure you would agree that when starting out, you also have to think about your risk. And, perhaps it's better to start out with standard, single occupancy buy-to-let. There's a wide range of products that newbies can get into.
Completely. You do have to assess what can you do, and actually how reliant are you on this business for income. Too many people are so frustrated with their job, their PAYE, that they want to dive into property on the assumption with this romantic idea it's just going to provide an income straight away and that'll be it. They can throw their job away and kind of sail away into the sunset without realising actually it's quite hard work. And I completely agree. Too many people are kind of seduced by the yields of HMOs and these success stories without realising the people that have done really well have been in property for 15, 20 years and learned the valuable lessons that you need to be on top of all of these things. It's very, very difficult, and there are a lot of pitfalls, and the last few years property has become increasingly more difficult to run well and be profitable. And going on a few forums and speaking to a few people and reading a few books just does not equip you, and is not an exchange for actual just experience and doing it.
Well, I agree with you 100% there, and I think it's really important that they have to have the 25% deposit typically. They've got to have the acquisition costs. All of that, those funds have to be in place before starting or even thinking about a property transaction. But just, I know you can't go into too much detail, but just generally, what do lenders like to see in terms of just standard buy-to-let, in terms of the criteria of the individual?
So I suppose the one transition people have got to kind of step aside from is, as soon as you start working with property, you are now a business. And actually, if you come to that mindset, actually common sense should prevail. Meaning, why do lenders want 25%? Because they want to be insulated from a loss. They're investing into your business that you are now going to run. So they want to make sure there's enough security to protect them. Now, the more security you have, the lower rates you'll get. Very common sense. But what you've got to look like is, right, if I've got a company, I want my assets, my liabilities, my value of the property versus my mortgage, my income expenditure. Naturally, you want to keep your expenditure low, your income high. But you've got to look at it and go, right, what's real term, what's the activity, and who is my client? Actually, can I secure this? Do I have enough income? You've mentioned, obviously, putting down a sufficient deposit and enough capital for the acquisition, but actually, how much time do I have to in order to afford this property to get up and running, established, get a tenant, and for it to start to create capital so I can move on to the next project. People are so busy trying to do the next project that they actually don't allow the one they have in hand to actually establish and create a foundation to build on.
No, that's again a very, very good point. And just before the camera started rolling, you were saying something that I found very interesting, which I'd like to get recorded. You were saying that people have to understand that they're actually underwriting all the mortgages and any other property associated loans they get. And, you know, that's something that you have to do in a business-like manner.
Absolutely. If you had a friend and they run their own business that wasn't property, and every single asset that company owned, the director had to sign a personal guarantee, you would say, right, how much money are you getting? What's the turnover? What's the risk for you? You'd be very cautious if you were a concerned friend. But in property, you do that with every single transaction. And yet, no one takes the time to analyse their own situation, which is, in my mind, very, very strange. Because if your business is completely reliant on the cost of the finance you get, being able to service the properties you have, but yet if somehow you miss an electric bill or a council tax bill or a phone bill that's late, your credit score is then suddenly reduced sufficiently where you can't get a mortgage, where now you can't service your business asset, your business collapses. So why would you not take the time just to make sure that your finances are in order, that everything is insulated, so your business can continue into retirement, which is what most people's aim is.
Yes, indeed. And of course, property is a long-term business. You know, we're here in 2020 and we're going to recommend that people have got to be thinking 15, 20 years to be in the business. Earlier you mentioned about people getting stars in their eyes and thinking that they're going to give up their day job after 2 or 3 properties. Well, sorry, I think you're going to join me in, kind of busting that myth. I myself been in property for 15 years with a reasonably sized portfolio, and I'm still not able to, relax on a beach in the Caribbean, unfortunately. I can see it coming in the future, but I think the main thing to understand is that if you give up your job after 2 or 3 properties, you'll struggle to get lending because there's only a very tiny handful of lenders that will actually lend on rental interest alone. So it's kind of counterproductive. People should be looking to run their portfolio alongside their day job until they really build up that traction.
Completely. Going back to, I suppose, building on the previous point, if you viewed yourself as a company and mortgage lenders are investing, what they want to see is, right, can this individual acquisition support itself? Yes. But what about you? Because you're a part of that business, you run that business. Can you survive? Can you pay your bills? Can you cover the void periods if this isn't occupied? Now, if you haven't got that income, then they're going to really start to scrutinise what are the background assets, how are you running your business? So I completely agree. For the first few years, actually, while you only have a couple of properties, actually, you're not getting rid of one job. You're taking on a second. You have 2 full-time jobs, and you need to create that capital, create that foundation to build, and have a really good idea of what are your outgoings and your committed costs and your margins on these for it to build momentum so it can start creating capital for you. Once you're in that situation, which does take a few years of really hard work, then you're in the position, I think, to actually start to do this full time and start to really phase out your full-time job.
No, I totally agree. And I guess just as we close out here, Graham, 2020, new year, new decade, have you kind of had your crystal ball out to see any trends that we might see? I mean, obviously, I think we're going to see more limited company products coming into the market, more competitive rates, which is good for landlords.
Agreed. It's very good for landlords. I think what is starting to happen is the underwriters are starting now to look at risk. They're starting to understand risk now purely than just what was strict criteria. Because now with limited companies, with HMOs, with a new type of accounting world which is out there and alternative structures for landlords, which is being heavily encouraged by and kind of persuaded by the government and their policy, underwriters are now having to look and go, right, even though you may not have the conventional setup, i.e. one man or woman and 2 or 3 buy-to-lets, actually what will that have an effect for us? So as long as we can get hold of the property, the risk is the same, we've got the same insulation, you're getting the same returns. Is there any difference? No. So I think limited company lending, alternative lending is going to start to improve. And I think actually now competition is starting to creep back in, because 2-3 years ago, landlords really overnight got hit with higher stress tests and higher coverage, and now as more data comes through and the risk is starting to be assessed, I think lenders are going to start to be a bit more competitive, but I think that's going to be the next 2 or 3 years before really that starts to come to the fore. So that's the only real prediction I can think of.
Oh, well done. Well, thank you for joining me here on our Landlord 2020 Vision campaign. It's running throughout January, and I do think, this has been a very good topic to help particularly newbies as well. And we do have a guide to how to give up your day job, the kind of steps that you need to go through before you can go into property full time. So I'll drop the link underneath this video, but for now, thank you to Graham, and also tune in tomorrow for the next instalment of Landlord 2020 Vision, powered by our friends at Less Tax for Landlords.